For the general market, I don't know if you'll agree with me, but this goes back to like the market making days when I would just stare at stocks all day. It's like if you stare at them long enough, you'll start to just see when the character changes. The stocks that are the most sensitive, like those will break down before the general market, or they'll be strong before the general market. So when you just kind of stare day after day and you're looking at the stock, which should be falling really badly, it's like the market's down. It's like, oh, that was pretty good today. And then day two and day five, it's like the market's, I don't want to be short this market anymore. And then I just naturally would always kind of find a way to be on the right side of the market before a major move. And I think one of the key things is that no matter what you're participating in, there's always one line I love by William O'Neill. He'd always say the only good stock is a stock that goes up. So like people kind of, they used to sports and it's like, oh, this is my team. There's no team in the stock market. Like this is a vehicle to make money on. As long as it's showing all the right things, I'll hold it. And if not, it's gone and see you later. So you need a good process. You need to rent the bubbles, but detach yourself so you don't become part of it, sounds easy, but that's the very difficult part.
Hi, everybody. Welcome to the Trading Battle. This is Boris Schlossberg. Welcome. Today, we have a super interesting guest today with us, Matthew Caruso. Gentleman has done everything you possibly imagine. He's been a market maker. He has won trading competitions. He's been a finance professor. He's written Canada's first accredited technical analysis course. So he's really been around the block, tremendous amount of experience. I am super happy to have you with us. Matt, welcome to the show. Welcome to the Trading Battle.
Thanks so much for having me. We had such a fun time talking before the recording started. I'm sure it's going to be an awesome conversation today.
We are, because I think, first of all, we know a lot of people in common. More importantly, I think we both share a real strong passion for the markets, and you certainly have an amazing pulse on the ability to profit from the markets. So before we start, we always like to know the backstory of the person. How did you ever even find financial markets as a vocation? Was this something you always wanted to do from childhood, or was this just something you stumbled into late in life? How did the whole adventure begin for you?
So funny, it's not long ago, my mom brought me back a sheet I had written. I think I was in grade 7 or grade 8, where I said my goal is to be a rich trader living in Florida one day. So it started from a young age, but it was kind of my dad encouraged me. He just worked, he was a telephone repairman, but it was his side passion was markets. And then I kind of got into it. I found William O'Neill's book one day, and that kind of lit a fire under me when I was a teenager. And that's just like been all the only thing that's been occupying my mind ever since, pretty much.
Really? Wow. Then did you, when you were young, did your dad set up an account for you, or when you were in college, did you set up like a first trading account? What was your experience of like putting your toe in the water?
So funny story is my first job was working at McDonald's, and I saved over after a couple of summers. And so my dad and I, to encourage me, he's like, Matt, whatever you put, I'll match you and we'll go on 50-50. We still have that
Wow,
account
it's like
today.
a 401k plan.
Yeah. So Matt, we still have that account today. We still trade together. And so
Wow, you wait. That's you still managed to have kept your first account that you started with your dad and without blowing it up. That's really
came
amazing.
close a few times. So when I found out futures and options, how they worked, I almost blew it up a couple of times, but
Oh, you did. So it just basically that account. It's been a joint account, but it's been added to many times. The capital's been replenished. Is what.
that's it. That things grow,
Yeah.
things
Okay.
change, but
That
it's been a
makes more
good run.
sense. That's great. So you guys trade together as as kind of a team. That must be a lot of fun, and it must be kind of a great bonding experience. You get to talk about this at dinner table all the time, huh?
Ah, it's great. And it's been a nice balance because if anything, like when I was younger, like he probably like slowed me down to not blow up an account, because when you're 17, 18, leverage equals what you think is more free money, but it doesn't quite work
Right.
that way. And at the same time, he had always invested, but was probably more on the conservative side of things. So I kind of pushed him to test and try new things. So as a team, it's been a lot of fun and great thing to do over the years.
So what sort of, fun gadgets, strategies, systems did you went down the rabbit hole with? Did you start out with stocks and you said, "Hey, we can do this with options with much more leverage, much less capital like everybody else does," or maybe even better, let's do it with futures. We can trade both long and short without any problems. Was that kind of like your journey?
Totally. So William O'Neill's book, How to Make Money in Stocks, the first one I found, and it finally I tried to read like Warren Buffett type stuff before, because that's what my dad was into. And if you're like 15, it's way too boring for anyone to kind of follow at 15 years old to buy utility.
Sure.
So Bill got me excited. And then I just kind of said, well, this chart part is like really cool. Like trying to, to finally see like this is a point you can buy and sell. So I got into technical analysis, and then I got into a lot of Larry Williams's work, which is really interesting.
Ah,
Great.
another great guy, and another great momentum guy who just sort of really, I think, invented in many ways a lot of momentum trading, right?
So much has to go back to Larry. It was incredible, but he was futures and all that, and he had, so, I mean, I learned a lot. It was kind of like drinking from a fire hose, but, like, he did a lot of work with Ralph Vince, who was into, like, a lot of these different, how to size your bets for optimal returns, and if you get it right, it's staggering returns, but the volatility of your account is, like, otherworldly,
Yeah. So,
So
like, and how did you? I'm actually curious. As time gone on, have you learned to emotionally control the natural volatility of large, sizing, or is that something you still struggle with?
It's come in stages, and, like, each part taught me something new. Like, working at the bank, managing bank capital was interesting because they were very flexible. Like, even though we are market makers, like, as long as overnight capital was within limits, you could pretty much do whatever you want if you're making money. If you're making money, they didn't really ask any questions, you know? So, that taught me in a different way to manage risk and understand drawdown, and you're down so much on the months and how you are doing for the year. So it forced a certain discipline on me. Um, but over time, it's like all these different steps kind of teach you different things. And eventually, when I was stopped market making and got back to kind of really just focusing on position trading, the volatility is much more because you're holding on a position, your account swings. So then I had to kind of, there was a point in time where stress was just running so hot. And when you're 18 and you can just go take a nap when you're tired at 4, it's one thing. But like when you have a family and kids and like all of the rest of life's responsibilities, like there was a point where I had to sit down. I said, look, even if it means less returns, maybe it'll mean more returns, but I gotta like pull stress out of this process. So I kind of then started to kind of figure out how do I minimize those sometimes it could be a handful of days, but it's like 5 days a year where you lose 5 years of your life. You know what I mean? Like, so I got
Yeah.
to a point where I don't want those days anymore. I may
Right.
make less money, but I don't want those days. And I
So is there sort of a floor of that like, for example, you say, I don't ever want to see more than 20% drawdown on any of my accounts, or is there some kind of a red line against which you sort of not position yourself so that you can sleep safe at night?
Yeah, what I found, the only time I would get into, I don't wanna say trouble, but those dramatic periods is when you're running really hot on heavy margin, and then there's always that point in time where it's like, this has to go back to, like, William O'Neill, which he taught us so much, but at the same time, sometimes it put, like, these, I don't wanna say exaggerated notion, but you look at what's possible, and even as a pro, you always kind of fall like, "Oh, this is the one that's the real big home run. It'll be like a super home run."
Right.
The cap and so, like, you're running hot on margin, and I just kind of realized that when you're running hot, you need a way to get off of margin very quickly, because if it goes even to a normal drawdown, the pain is too hard. Even though ultimately if you end up higher, it's just such a hard punch to take. So a lot of it is because, and everyone has their own weaknesses. My weakness was I'd stay too heavy too long, and then after take the other side. So I just kind of got to a point where like I don't mind leveling off a little bit earlier than going over the cliff and then having the pain later on.
Does
That
that
that's
does
a
that
part of my
mean does
strategy.
that mean you sort of scale out earlier now and, reduce your exposure, quicker so that, you don't necessarily hit the full target, but, you just try to take a little bit along the way? Is that your
Yeah,
approach?
so like when I'm running hot and things are going well, then it's like a more focused plan to say, okay, well, if I'm, let's say, 160% invested and I want to get down to 110, 120 very quickly, like where are those stocks that are coming off like immediately?
Right.
And often when I start to already just start to think those thoughts because of like different, let's say, P&L targets that I'm seeing and I'm reaching, like I've gone to the point where I'll just like, you know what, just take off 20% already. I remember when I was younger, at one point, Interactive Brokers like wouldn't give me more margin on some of my stocks, so I changed broker. And looking back and like that was the warning sign that they were trying to help me. I
When
should have
your dealer cuts you off, you know
oh,
you
it's a
have a
very
problem.
bad sign, yeah.
You know you have a problem. But, speaking of that, I'm actually curious. Market making inherently is the opposite of, I think, retail momentum trading, because market making inherently is a mean reversion strategy. You're selling to the buyers, you're buying from the sellers. You're always on the opposite side of price flow, and so much of market making is literally having enough capital to average into a position, then blow it back out. That's the beauty. It's the beauty of having other people's capital, is that you could be so large, you could just absorb so much pain, and then just a little bit of reversal, boom, 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 you make money. You can't do that as a retail trader. But I'm wondering, how is the transition? Like when you were a market maker, is that sort of how you traded? Like sort of, you were naturally, you were providing liquidity, so you were buying when everybody was selling, selling when everybody was buying.
So it was funny with the saying we had on the desk was, "When you're in doubt, get out. When you're in trouble, double." So it's like kind of that's what you're saying. You try and fix, like we used to say. I say, I'm going to fix this trade, and like, yeah, you'd always keep enough capital. Exact same mentality. Kind of,
Yeah.
there's a terrible news announcement, you have to adjust, but in general, you're trying to fade everything. So so again, like they were very flexible with me, and this is kind of where I adapted my strategy because I remember 2010 was a really good year, and I was running kind of positions, position trading alongside market making. I used my capital basically all for position trading. But there was a one point where I kept kind of buying breakouts because that was just the system, right? Like it's taught you buy breakouts. Right. I had like loss, loss, loss. And like I was looking at these charts, I'm like, but this is the opposite of how I run my business all day for my market making operations. Like I'm just blindly following. I'm like, even if it's a good company and you see like a runway for 6 months, like I don't have to buy it right there. It was just like kind of like, no, when you learn things, you're in that zone, you
Right.
just follow along. So for me, that was the point where I kind of I retained a lot of even what retail investors use for like that strategy for position and momentum, but how I enter, how I build positions, then kind of reverted back to my market making, where I'm looking for these like non-intuitive entries and other ways I can put on low risk position.
Is that what you continue doing now? Is that sort of the core of your strategy, which is sort of like these non-intuitive entry? You don't chase, you don't chase, you retrace kind of sort of the ideas that you try to look for.
Yeah, so like my two favorite entries are like I almost always avoid breakouts. My two favorites are either like a pullback after a breakout or like points of volatility contraction. Like for me, everything is always relative to the risk I got to take on. Like a market maker,
Right.
you're always looking at risk first. So it's like when the stocks have these wide range bars and it's a big move for me, it's just like yeah, it could go up 30%, but if I got to take on 15 to make 30, like it's not a very good like
Right.
risk reward for me. So I'd rather wait to have things kind of tighten up, and that just sets up like a nicer
So
like
you wait for volatility contraction and then hope for expansion. You hope for a second wave explosion. Basically, it sounds like you just wait for volume to sort of die down and then fresh volume to come in and
Yeah,
take it to
exactly.
fresh.
And all like these are all such like classic like trading tools, like things like, like Larry Williams would talk about and others like, narrowest range in 7. Like there's all these like I like to teach. So I was even like a finance professor, like, and so like I like to connect all these dots. Like I loved like learning these old strategies from the old floor guys and stuff because there's like all this like wisdom. They did it so much simpler like back then, like, pre-computers and all, but it's the same wisdom.
It actually is.
That
Yeah, I mean, that's and actually the more I trade, I also find that, the simplest the simplest ideas are these, like, for example, Tom Basso, another great market maker. I
yeah.
He was a great trader. He had just said to me one time in an interview, he said, "I don't care about anything but highs and lows. I consider everything else to be just noise." And I even like, sometimes you subconsciously don't even absorb that as truth. And I actually created a whole strategy off that. That's exactly what we use in our trading day to day, which I'm just basically looking at highs and lows. Everything else is kind of noise. And it's really true. And that's a very simple concept from olden days that works really well underneath because markets are basically haven't changed. They're an auction theory product. And if you understand auction theory, you kind of understand how flows happen and you combine auction with volume and you pretty much have the whole idea what market making is. Is that what you sort of teach in your courses? Tell us a little bit about, your academic background and what spurred you on after market making to come in and maybe also create your advisory firm as well.
Yeah, so that was kind of like interesting. I entered the competition in 2020 because I'd read about it in Market Wizards and all the rest, and so that year it just so happened everyone fell in love with trading, and so I had a following. People were literally at like, "Man, you trade?" So I said, "Oh, I used to teach at the university for a few years, and I'll put together something. It's something I enjoy doing. And when you trade for yourself, you have a lot of time during the day at different times, so it was a fun passion project. And naturally, those who learned from the course then wanted like more kind of like a real time market analysis. Is what I
Mm.
then built out. And what I like to kind of teach is I know people focus on patterns and all the rest, but for me, the way I learn at least, and what taught me so much when I was a market maker is the patterns are just representing that demand and supply. And like you mentioned, like highs and lows, you know, um, like I was explaining to people, like they're not necessarily chasing your stops. It's just that, like, especially in the old days, like if you're trading before HFTs, like if the stock ran up to, I don't know, $21 that day and stopped dead at 21, chances are there was a big seller with a big order there, like blocking price. And the reason you get a volume surge is someone would say, hey, look, you have a million to sell at 21. I'll take it all, plus use another 500,000 on the bid. And that was the
Exactly.
volume, that was the
And that
breakout,
is exactly.
you know?
That's the dam that breaks that we've all been there.
Exactly. And like, like a good friend always taught me, Matt, like volume attracts volume. So, it looks like, oh, there's this big scary seller, but now a buyer says, oh, I can put the position on in one buy, I'm gonna go and get it. So it taught me, like, what was great was that it taught me how to understand what the price patterns were that I was looking at, like what it really meant, like what was going on, instead of just like thinking of it as like graphics on a chart kind of thing.
Right.
And so a lot of what I try and teach is kind of like there's the fundamental side of the companies, and like a company ultimately goes up over time and it's doing something valuable. But between now and then is all the demand and supply of stock. And it's all about trying to read what are the biggest players doing. Are they, and they can't hide their tracks. It's visible.
Yeah, I mean, that's the great thing about prices is it's transparent to everyone. Like, it's, price doesn't lie. Um, but do you, like, speaking of fundamentals, do you analyze the company? I mean, do you follow the stories? Are you aware of the stories around, the stocks that you're trading? Um, does it enhance your analysis in any way? How do you, approach that?
It does. For me, it's a big part. Like, and I'll admit, when I was a market maker, I was like almost purely a chartist. I remember I was trading one stock for like, I think a month. I thought it was a gold stock, and I found it was an oil stock. I never had that. I never took the time to check. I was like, oh, that's why it was trading differently that day. But those are different days. But now for me, like, I'm a very thematic type of trader. And even when I was a market maker, because I would always kind of make the market alongside like a core position if I was bullish, and I would, or the other way around. And so for me, it's helpful because then I can kind of see who the leader is in the theme. And that's where like William O'Neill's teachings came in, the whole concept of like the leader of that theme. And that's really where the alpha, like the big outsized returns come. Like if you can get the leader of the theme, like, you're always taking on the same market risk. Like there's a market correction, it falls, but the leader will have the outsized return. Like look at, Robinhood, it's just been on a tear. Like that's just the total leader of like the crypto, like fintech revolution. And like, it's
Right.
an order of magnitude above what all the competitors are getting. So if you're going to be long that group, make sure you're long that stock. And that's how.
Really, it's so interesting. Like, much as we just hate to admit that fact, but the Pareto principle is always present in the markets, like in almost every aspect of life, but nowhere more obvious is it than in the markets, where to the winner go the spoils. If you sort of understand that, you can understand so much of, winning in the market. I mean, in fact, index investing is nothing more than just simply making sure you have the winner in the basket. It's just ensuring that you got that one winner in the basket, since you don't know who the winner is, and everything else is in a way is trying to look for that one winner, amongst the pack, because
That's
that's
right.
what
Like
the
like
other is.
buying a basket is they're basically pyramiding for you, like through market cap. That's basically what's going on. Like the winner keeps getting more and more stock, and they're just adding to the winner essentially as a weighting. So
Right, but it just, but basically they know by default they're going to have that one winner, they're gonna have that one alpha, and that's like it. Typically, when you look at, like, what was it? I forgot the something like, um only 5% of all stocks in the history of all stocks are responsible for literally all the stock market returns. Right, like 85% of companies.
yeah, I remember that was interesting.
Yeah,
Yeah, that was floating around a while back.
it's an incredible figure, but, like, it's very hard to pick it out. Yeah, so the leader is the key, right? That's sort of like the key to your, positional trading, is you wanna find the leader
Yeah.
in whatever it is that you're trading. I'm actually curious, what are you trading now? Like, what sectors, have your interest, and where do you see the leaders? Like, what do you think, the strongest flows have been over the last 6 months?
For me, this cycle, like sometimes, and depending, like, sometimes as a trader, you're just off. Some cycles you don't get it. This one I've been really bang on. It's been the AI thing, and everyone's tired of hearing it. But like, and that was something that turned me off originally, because as a market maker, you tend to naturally become cynical, right? Because you're always fading everything. Or natural, like it's hard to be a position trader and a market maker. It's like two very different ideologies
Yes.
clash in a sense. But like I've just learned, and like over time, like I remember when the cannabis like theme took off, like a while back, like that's what I totally missed, because early on, I remember the companies that had nothing. They were like garbage companies, and it was like very, you could tell they were just kind of like leaning into what was like the current thing of the time, but they had like tremendous moves. And I told myself that's the last time I like ignore a theme just because it seems ridiculous. But this one here, I could see like the real value creation that'll be driving from it. And that's been my absolute focus, and trying to find all the different angles from which like people will benefit in different ways. Cause like the internet rollouts has been my playbook to follow. And I think we're in there's like usually like three phases of most revolutions. The first is infrastructure, where everyone doubts because it's all the capex point. Like we're spending money. It's like when you're putting down the railroad before the trains change things. At that point it seems stupid. Like why are you spending
Putting
all
down
this
transatlantic
money?
transatlantic cable for the internet, same thing. Everybody thought that was a waste of money.
Exactly. Exactly. And then once that comes through, then after it's the initial products that people build on that, and then eventually there's a whole new wave of like revolutionary things you can't imagine today that build upon the stage
Right.
two.
Like literally like a whole paradigm, like, the Amazons, the
Exactly.
Facebooks, the Googles.
Exactly. You couldn't imagine that like in how could you imagine Amazon like in 1994 like the scale and everything that it built is like another
Yeah,
market.
it was just funny because I'm old enough to remember this. I was just thinking about YouTube the other day, and I remember when YouTube got bought out. I mean, YouTube was basically like a $2 million website with like 300 people on it, whatever, and they bought it for like $100 million, and everybody thought that it was the craziest, most insane, most overpaid thing that Google has ever done. In the meantime, the thing is worth almost probably like $1 trillion at this point. I mean, it's literally the television for the world. It's basically global television. Can you imagine owning everybody's, not just American eyeballs, but every eyeball in the world, uh, for 3 hours a day? Like, we're all on it. And I was just thinking just how easy it is to miss the opportunity when when you're just looking at the present. Yeah.
Well, in 2010, like I said, that was one of the years I really got like my position trading to work very well. And one of the big winners was Netflix for me. And I always say it's a great example because it's hard to believe, but everyone hated Netflix the whole rally up. Like they thought it was overvalued. Like, oh, Comcast, they can build something. It's just a website. It's just their legacy business is just sending DVDs in the mail. Like streaming won't catch on. Like it's so like looking back in real time, it's always so difficult. But then you look back, like, how could people have not thought that streaming was going to be awesome? Like compared to like putting a DVD in and like having to bring it back. Like it's so like it's so for me, like AI, like I get so many. Like I was watching something on CNBC the other day, and everyone like the roundtable was, "Are we in a bubble?" Like maybe I don't know. You never know in real time, but usually people don't say you're in a bubble when you're in a bubble. But like if you look at the like for me, ChatGPT has become such a center point of my life.
Yeah.
Like not just for trading, I get news on there, researches companies for me when I work out, it does all of my like my it's my personal trainer now. Like it's so transformational when you see this kind of change. You can't ignore it. And there's gonna be some people who are like just constantly negative on the new because of valuations or whatnot. And every cycle, you'll miss the biggest winners if you kind of approach it that way. So
Yeah, I think that's true. If you're just only value focused, you miss
every
the
time.
absolute big winner cycle. So within AI story these days, who do you think to whom go the spoils these days? Who do you think is the big winners?
So there's a number of like different like ways you can look at it. There's like the whole power story. So like there's GE Vernova, there's Talon, there's Vistra. Which I mean, they're gonna have to change the whole energy grid with the amount of demand that's coming. And then there's like the whole semiconductor trade, which is longer in the tooth, like the Nvidia. But there's newer names like an AMD, which I think has big potential because if you look at the demand for Nvidia, that's all been this demand to train these new models. Like if you
Right.
think about once the models are trained, like just like you said with YouTube, it's gonna be like the usage of these models is gonna go up like 100x. And so AMD has their newer chips is designed more at like the running of models, which I think give them like some really big runway. And there's like all the other like ancillary type of like positions like NBIS is one that they focus on basically these neo clouds where people can kind of rent out these GPUs in a more cost efficient way. So for me, it's very much still the infrastructure stage, and you have to look at who's coming around. Like Tesla, did they do the robo taxi? That's like AI applied to the real world. Same with the robotics, that's AI applied to the real world. So always trying to find the different angles of who can win. Like for example, today there was news that ChatGPT is integrating Shopify and Etsy into ChatGPT so you can order online. So like now suddenly like Etsy, which is a $7 billion company, is going to suddenly get all this order flow from ChatGPT.
Oh yeah, I mean
On
it's amazing.
the
I
users.
always like now. Do you find yourself? I find myself all the time if I'm like in Google or somewhere else, or I'm in some website where I have to ask the stupid website some question, and I'm like, why isn't this in Chat GPT? Because whatever question I ask, it's got to be keyword match, and it's of course never going to give me the right answer. Doesn't have interpretive abilities. I just I'm at a point now where I can't stand this. Why isn't this all Chat GPT?
It's amazing, and every time you feel that way, the market always catches up later. Like it's incredible for anything. It could be clothing, it could be technology, it could be automotive. Like when you feel that way, it's like before the market catches up and positions, it's always early. It's something important to follow.
Yeah, that's really, really true. Now, I mean, it's sort of like, I heard that you have this philosophy called unshakable optimism and continual growth. Uh, is that part of it? Is that sort of the idea that progress is just inexorable, especially in our Western capitalist societies where we have lots of incentives for progress, and that it's foolish to bet too much against innovation as you go forward. Is that true?
Yeah, so, like, at one point, like, so, I used to make markets. A lot of the stocks I made them on were gold stocks. So when you trade gold stocks long enough, it's normal you start to kinda drink the Kool-Aid and you say, "Oh, problem." Like, every talking point you hear today already existed, like, 15 years ago. Everyone was already talking about those same talking points.
Right.
And there's one, and it's not to put anyone down, but, like, there's guys like Peter Schiff who have, like,
I know him.
tend to have, like, a negative bias, but when you first kinda walk into it, they're very well articulated arguments, and there's a lot of truth to a lot of them.
Right.
But then, and so I remember when I kinda got into that at one point, and I was trading gold and doing really well trading gold, and it's like, "Oh, things are gonna be negative, and there's a debt problem." And, like, I got into this really negative funk for about, like, 2 years, and I missed out on some great stocks. It made me, really negative even as a person, like, "This is gonna be bad." Like, everything, like, suddenly is gonna be bad. Like,
Right.
if you look at anyone who sells gold, like, everything's gonna be bad. Like, you need gold to protect yourself? And so for me, and I remember I kinda, and, like, I got even into a drawdown at one point, and so I kind of would go back and read other people, and William O'Neill was, like, tremendously optimistic because he had this kind of growth mentality, and capitalism, free markets will always lead the way. And, like, it took me time to, like, shake off that negative bias, and when I did, I'm like, I'm never going back to that. Like, it's always managed risk. Like, I think people who, like, YOLO, like, just buy and hold and all that,
Right.
that's a recipe for absolute disaster. But when you look at markets, you have to, I think it's important to always figure out, like, okay, my risk is managed, so I'll exit if I have to, but I always have to assume that, like, good will come out at some point. Manage your risk, and then how do I get back in to kind of re-participate in the growth of free markets? That's my view.
So if you have we haven't had one in a long while, but when we have the 25, 35, 45% sell-offs,
Mhm.
that's a time when I bet, I mean, are you excited at that point? Because you're like, oh, this is amazing. There's like a lot of bargains going on. Um,
Yeah, it's definitely, it helps. I mean, like, it kinda sucks because then you're kind of on the sideline. Like, I never liked the short side. It was never really
yeah.
a strong suit of mine. So you end up, like, not doing much, and you get the itch, and sometimes you get yourself into trouble just out of boredom kind of thing. But, it definitely sets up opportunity, because the beautiful thing about market corrections is not so much that they're coming down so things are cheaper. It's part of it. But whenever the market pauses, it always shows you where the real market demand is. Because if a stock doesn't break lower when the market breaks lower, that's like, it's a surefire, like, the market is screaming that someone's accumulating it. Like, if you're a higher beta tech stock or whatever stock, a consumer, retail stock, and the S&P drops 15% and you're down 6%, like, someone said, "Look, whatever you're all selling, like, I'll take whatever I can over this month or 2 months." And the second the market turns up, there's no more stock for sale. You have to pay higher prices. And so for me, it
you know,
definitely just makes it clearer of who's being bought.
it's funny you mentioned that because I just remembered. I know I've always been a day trader, and I remember Sun Microsystems in the heyday of the dot com. And there was a day when it was like a 300 point down opening in the Dow when it meant something. That's like equivalent to
Yeah,
maybe
that was huge back there. Yeah.
2,000 point down opening in the Dow now. And it was a massive, massive decline. And it was just market open and Sun, and it was CNBC was screaming, and I think Maria was screaming, everybody else was screaming. And the only wish reporting was showing Sun, and Sun was the only one that was flat on the day. And it was just like they were trying to knock it, knock it, knock it, and it stayed, stayed, stayed. And then the market just kind of paused and started to reverse. And that stock just shot to the moon. It was like it
Yeah.
was such a perfect example of where if they ain't selling it when everybody is, it's going to moon when it turns around.
And it moons because not only is someone absorbing the stock, but like you said, every trader, even back then, every day trader, I used to do it too. Like, the stock that's not breaking, you try and break it. And if it doesn't break and then the market turns against you, not only is that buyer still there, but now people sold it and they're buying it back. And if you shorted it, you have to buy it back. So you end up with this, like, wall of just one-way buying because everyone is offside and this buyer absorbed all of the selling. So and that can happen over a day. And if you look at all the best stocks, if you go back, like, 90% of them during the market correction, at some point you can see they just start bucking the weakness. And that's someone who's absorbing it. For me, that's one of my, like, my most power, my biggest focus is always on relative strength. And that's always what it kind of helps me to isolate, like, the leadership.
That's the number one thing you like to look at, relative strength. Like when things are bad, who's strongest? That really perks up your ears. And gets you interested in a position.
I need two. All I need from if I had to boil it all down, I need two pieces of data. I need the price data of my stock and the price data of the S&P 500. With those two, I'll be able to find like where I want to enter, whether there's relative strength, whether there's accumulation. For me, though, that's the only like I look at other things, but that dynamic is like 90% of what.
90% of the work of what you want to.
And like you said, eventually everything becomes like once you get used to it and you kind of keep cutting away the noise, like you try and get to like the simplest like root of
Right.
your process possible. For me, that's what it is essentially.
So you're both a student and a practitioner of the game, and I understand you've studied a lot of great traders, including somebody like Paul Tudor Jones. I wonder if you could tell me what are the lessons from his career that you've learned.
So now it's like we take for granted there's so much on YouTube, but like those Market Wizards books, like I used to like pour over them like line by line to figure
Yeah,
out like
me too. Me too. I had I once met Jack Schwaber. Sorry to interrupt you. I once met him, and I said, "I have literally read your books 30 times." You know, it was like I read them more than most people have read the Bible. And he was laughing, but yes, absolutely.
yeah. So I remember like with Paul, like he had a great, chapter in there as well. There were a lot of great guys. But, like, there was one part where he was talking about how sometimes you try and nail a bottom, and yeah, he's like, "I'll take multiple attempts, but if I can catch that turn or even for a top, you'll try and short a top." He's like, "I know it's counterintuitive, people don't like to fight the trend, but if I can do, like, multiple, like, small risk attempts at that turn, if you catch it, it's a really big turnaround." So there's some elements that, like, I took directly. Sometimes it's as you're looking at your process, you take different variations. So for me, that was one thing where again, kind of like which conflicts from like the Bill O'Neill style of things and is closer to my day trading type of stuff. Or is, like my main focus is I love to put on trades with low risk. I don't care. Like people have a real kind of sore spot for a low win rate. To me, like win rate doesn't even matter. Like as a market maker, you trade so many, as long as your P&L's positive at the end of the day, you don't care how many times you're wrong or right. You want a positive number. So for me, it's like if there's a stock that I think thematically is right, that I think is under accumulation, like, the kind of that Paul Tudor Jones thinking, like, if I think it's bucking the market weakness, like, I'm gonna try and attack it as many times as I can. For the moment when the market kind of finally comes back my way, this stock should then kind of blast higher. So it's like taking that flexibility, which goes back a lot to even if you go back to like Jesse Livermore and reminiscence of a stock operator, like the way he would build into positions, like it's like basically Livermore, like Tudor Jones. That's kind of really what guided my structure for building size 'cause, like, Bill O'Neill loved to have big size, but he never really described how he got to the point of having a concentrated position, which is a very important step between wanting to get to, like, a
Yes,
concent
yeah,
and getting
that's
there.
the
You don't
secret
wanna
sauce
blow up.
that nobody tells you. Yeah,
Exactly.
what, do you have any specific stocks in your past that you remember where you went after it 2, 3, 4 times and it just, stopped you out, and then you caught the turn? You remember any of those stories? Any,
Um, you trade so much, you kind of forget, on the spot here, but,
like, what was a great turn trade that just to this day, you're like, "Man, I caught a really nice."
the one of the best is what I in 2020 was Livongo. They did, like, medical diagnostics, and I remember I was for me, it was like, COVID was gonna be a medical war, and they were gonna throw money at whoever could help them, and I was looking at Bethlehem Steel, which was, like, one of the big winners from World War One, and had very similar chart characteristics. So I remember as the market was, like, in free fall, it was, like, it was terrible. It was
Right.
March or whatever it was, and this had that first, like, push off the bottom, and then it consolidated. And it's like I was in every chance I could try and find like a lower until I built up like a 40, 50% like concentrated position. Then it just like ripped, like there was no tomorrow. And that was one that I nailed. Then there was a buyout. Like I literally top ticked it on a buyout with the Teladoc.
Right.
That was it. That was
How do you have the fortitude to stay once it starts running? Do you, like, is that just part of your personality? You're perfectly comfortable holding floating profits? Because I'm, for example, a person who I'm never able to hold
mm,
floating profits. I don't have any issues like, getting rid of some people have a hard time letting go of floating losses. I don't have any problem with that, but
mhm.
I have a really hard time holding floating profits. How do you hold that?
I was that way. And it's something like I had to build up to over time. Like it wasn't so much holding floating profits. For me, it was holding them for a long period of time for like months was like impossible to me, like in the
Mm,
past. Like it was I always itched at some point and I'll buy it back later and then you would miss it kind of thing. But what really got it for me is really kind of when I went back and I studied all of these leading stocks and I even looking at my history of like my best returns or my best periods, like I noticed like you have to have that 3 to 5 month outlook. Like, even though stocks can have a tremendous 18 months or 24 months, that's not my target. Like I learned that I feel comfortable, I feel good maximizing the 3 to 5 month like up cycles. And there's usually then after a pause somewhere. And so kind of once I realized that, like I was always very good at catching market turns. I never got caught off guard by a bear market. I never got caught off guard by a new bull market. So I just kind of start to kind of force into my mind like the stocks that are the leaders of this cycle. I need to get like at least about like a full portfolio allotment in there. And then around that, I can trade it. I can trade around there, but I have to force myself to keep those. And what helps me is that once I have enough profit, like the stops get to break even. So it's like kind of like a free roll at that point. So the pressure is off. But it's not easy. That's where you have to really manage. Like I was saying, that's where I would run into trouble. Where if I was on heavy margin and things are working well, if you don't manage that, it's always stairs up and elevator down. Like the down
It's
days
always
are
the elevator
brutal.
down, and it always kills you. Yeah.
And even if you're ultimately right, you can't sustain it.
You can't survive the free fall. That's the
Can't.
problem. You can't survive the free fall. Yeah.
I've been doing 20 years. Unless you really like, I don't know, unless you're inhuman, like it's gonna break you if you don't if you don't find a way to manage around that. So
Right.
so then part of that selling process with that thinking with time, I just developed a kind of a routine of what to expect, what to hold, how much to hold, and it made it a lot more comfortable along the way.
Interesting. Now you said you're pretty good at avoiding the bull traps and the bear traps. What do you think? Like, what specifically do you do to kind of not get caught off sides during turns in the market? Like right now, a lot of people are bullish. Some people are like, oh, we're just ready to turn, and it's gonna flush to the downside. What's your view? Like, how do you sort of um prepare yourself for any kind of a steep decline?
So, like, I don't have to go into all the details of the individual indicators. There's different things I'll look at that kind of give me like on a like on the weekend when you're calm and you're looking at your indicators. There's some tools like I'll look at discrepancies between the VIX and the S&P and different tools. But the real heart of it, the reason I've never got like my weakness has been chop. Like I had to work at not over trading in directionless markets. That was my weak
Yeah.
spot.
Yeah.
But for the general market, I don't know if you agree with me, but like this goes back to like the market making days when I would just stare at stocks all day. It's like if you stare at them long enough, you'll start to just see when the character changes. When the market and the stocks that are the most sensitive, which is what I've always traded, is the more sensitive side of the market. Like those will break down before the general market, or they'll be strong before the general market. So when you just kind of stare day after day, and you're looking at the stock, which should be falling really badly, it's like the market's down. It's like, oh, that was pretty good today. And then day two and day five, it's like the market's. Yeah, I don't want to be short this market anymore. And then I just naturally would always kind of find a way to be on the right side of the market before a major move. Like that's
What about, I mean, the short side is interesting, but what about like the long side? What about getting out of the way before markets collapse? Like, how do you what do you look for there? How do you see the exhaustion points?
very similar process. If you look at the leading stocks, like they just stop going up at and it stands to reason because if you're an institution, you want to, you have to be invested. Like I'd rather own Apple than, Robinhood if we're about to go into a market correction because,
Sure.
Apple will fall far less. It's far more secure. So you'll always see that, like, it takes time. Like you'll always see these rotations over a week, 2 weeks. It's like you don't get 6 months notice, but like it's very like the only times I've seen the market just like top and break, like, or like in a rough way, it's because you're going into like one of those very like again, that goes back to my other problem where you have to kind of scale out when things are going really well. But beyond that, like before a market goes into a deeper correction, I mean, there's almost always that period, that lull where it's like chop or there's like that subtle weakness under the surface, which you don't get I've noticed you don't get the right feedback just by looking at the index. It's only when you do the hard work of like studying
Of
all
the
the
underlying,
components
yeah,
every
of the
day.
underlyings, right?
And so the person who turned me on to that was, Ralph Acampora? He's one of the founders of the
Yeah, yeah, sure.
CMT.
Yeah.
So he used to come and speak to our CMT chapter, which I was running for many years. And I was a kid. I was like 21. I was running the chapter because I was obsessed with trading. And so he comes in and he's like this pro, and he was like, everyone was so excited to see him. And I was running the charting software. He's like, what are your favorite indicators? I said, oh, I like this oscillator and that and all that. I'm like, how about you, Ralph? He's like, I just like to look at all the individual stocks, and I'm a bottom up kind of guy. And it was like, and I always kind of revered Ralph because he was the man. And I said, "Oh, like, I don't do that at all. Everything is like just top level down." And so I started to kind of force myself, and it provides surprising insights.
Interesting. That's really interesting. Yeah, yeah, yeah. Yeah, I mean, like you said, sometimes the old-fashioned way is the best way to all of this stuff. Now you said, relying too heavily on stop losses can be dangerous. So, what do you have like as a sort of do you have a general parameter system? Do you have a hard stuff? Like, how do you manage your risk internally.
Yeah, so one thing I hate is when you have those down days, if you just have stops everywhere, it's like you're stopped out of everything, the market turns back up and you're gone. You
Right,
have
right.
no
Yeah,
and
this
it's
is
like you
we
took
all,
the
we
and
all
then
love that. We all love that where it just stops you out and then the race.
brutal. So for me, like again, the way my thinking works, it really works around like I think of it like a campaign. Like that's what me and my dad, was talking about like that. We always talk about like this campaign. Like, we're in the current campaign since May. And once you have your quality stocks that like these are my core. So like let's say you're comfortable going up to 160% invested. Like these stocks represent maybe like the full portfolio without the margin component. The aim is to protect those. Like if the markets are going to have just normal pause, I don't want to lose those stocks. Like the key is to sell everything else that's of lower quality or I bought later or was a trade that I put on recently. So once we have good gains, those stocks are like about a break even, but I don't trail a stock because then on one day it's gonna knock me out of everything. So my key is more like looking at the market and selling into strength. And then after I have different tools, like I'll look at the market, the amount of stocks making 52-week highs versus 52-week lows. I'll look at something I call the FOMO indicator. I'll look at the percentage of stocks above their own 5-day average. And so I've kind of built kind of like a ranking system based on that. Like, in this market, I should be 0 to 30% invested or 30 to 70% invested or fully invested. And so that kind of like if I get lulled into like falling in love with my stocks, that system naturally forces me to like, look, you have to bring risk out or you have to put risk on. Because sometimes even when the market's rough, like in April, May, I don't think anyone was seeing this rally come. You have to force yourself at the turns to kind of participate
Right.
with what you see, not what you think. So those are like some of the main tools I use.
Super interesting, but also it's very interesting. Like just even sort of a simple thing, like you said, number of stocks above their 5-day moving average. That'll be one of the first key indicators to tell you that we're starting to break down. Because as soon as the stocks gives up its 5 MA, the index is clearly on the cusp. Because like you said, there's always a distribution layer
Yeah.
before um, there's a decline.
And actually, that indicator has been so helpful to me because if you look at these leading stocks, let's say that's Robinhood, we're talking about it, it's up a lot. If you put like any kind of momentum oscillator, an RSI, stochastic, a Bollinger Band, Kellner's channel, like it'll always have you sell that stock way early. Like the traditional technical analysis tools for selling don't apply to these leading stocks. So I remember finding myself kind of like, even though I'm like a practical trader, like I like the teaching, I like the theoretical side of stuff too. It's like, so I said to myself, how can I adequately figure out when it's time to sell or even lighten up on the best stocks? Because it happens sometimes you're fortunate and like all of your stocks are like bang on. They're all doing great. So now great. What do I sell? And so I kind of got to the point where when the majority of stocks of all stocks on the NASDAQ are above their 5-day, let's say there's 85 or 90% of stocks above their 5-day. Like even, the old thing is like, even like a turkey could fly in a windstorm. Like when everything is so hot, that's when the leaders need to be reduced. So like you don't want to sell a leading stock on its strength. You want to sell a leading stock when the junk is strong. And that
Interesting.
was that was like a key moment that helped me to be able
Wow,
to
that's a,
manage.
it's a really interesting insight. Wow, it's fascinating. Now you have a how big is your portfolio? Like how many positions are you managing? Uh,
Like so like usually when I'm like trying to feel out who the better stocks are going to be, I can get to 10 to 12, but then naturally like through my process I always get down to maybe 5 to 7 is what.
but it's not like you're holding hundreds of positions and you're
No,
managing. You just
definitely.
you're weeding through a lot of stuff and you're just really focusing on prime real estate,
Mhm.
as we say.
Yeah,
Um,
that's absolutely
and
my
what
focus.
is your um daily routine like? Like, how much time do you devote to the market? Like, what do you do on a day-to-day basis? I mean, I'm sure you obviously have your business. You have a consulting business. I'm sure you do lots of work for that. But like, how do you allocate time to just actual stock market research?
Well, for me, the morning has always been like the key time. So like between 8 and 11, at least 8 and 10:30 if I have to do something
Yeah.
afterwards. But 8 to 11 usually is like my market time. Like it's just like I don't want to be bothered. It's like I want to see every tick. I just want to sit in front of my screen, stare at price action, and then throughout the day,
Interesting.
yeah,
So that's just sort of that's also part of your. So it's not necessarily that you're day trading. You're just watching price action, on the open from till about 10:30, 11, when
always.
basically when the European closes, because that gives you a really interesting read into what's happening, right?
Yeah, and that's something I picked up when I was day trading, but I've kept it because to me that is like that's my market research. Like just staring at like I just people wonder what you're looking at all day, but for me, just staring at the price, how everything is moving on every time the market falls, quarter percent. How does each stock act? To me, that is the flow. that I try and get into and understand what's going on. That's my key time.
Very interesting. That's it. That's interesting. So you don't necessarily. It's not even like you're acting on it. That is, you're just watching the price action, absorbing that, and that
Mhm.
it then informs your overall idea of of
Yeah,
what you're doing. That's kind
absolutely.
of very cool.
Yeah.
Um, what's the biggest lesson you think investors need to learn from the great bubbles of our time, like the dot-com bubble, the real estate bubble? Uh, what are those lessons that people have to learn the hard way?
Yeah. So it's interesting because there's this really good book I liked. It was called How to Get Rich by Felix Dennis. I don't know if you ever read it.
Well, but who's it?
Felix Dennis, How to
Never.
Get Rich. No, that's something a friend of mine is like, another
To go look it up. Yes.
it's a good book. It's in a good story. He's a really interesting story. Anyways, you should
Okay.
really read it. Really good. And it's funny because he says in that book, and he's right. He's like, if someone tells me there's a bubble, he's like, I'm gonna run to that place wherever it is because that's where all the money is made is in these
Yes.
bubbles. And it's true, like so, like all the discussion is it an AI bubble? Was it a dot com bubble? Yeah, dot com was a bubble, but how much money could you have made like before the bubble burst? Like and maybe it goes on for a year or two. It's sometimes you think it's a bubble, and like let's say Facebook, was that a bubble? I don't know. Social media hasn't gone away. It's still building and climbing. Same with Netflix. So one thing is like, I think you shouldn't be, speaking of bubbles, you shouldn't be turned off by people saying it's a bubble because there's some truth behind a bubble that launches a true bubble. And then if anything, the biggest gains could be made. The key is to not go over the cliff, over the edge. That's the hard part.
That's the hard part.
To
Yeah.
be able to participate in it, but then not,
Just
you
hop
know,
off the horse before it starts.
exactly.
Yeah.
And I think one of the key things is like no matter what you're participating in, there's always one line I love by William O'Neill. He'd always say the only good stock is a stock that goes up. So like people kind of they used to sports and it's like, oh, this is my team. There's no team in the stock market. Like this is a vehicle to make money on. As long as it's showing all the right things, I'll hold it. And if not, it's gone and see you later. So you need a good process. You need to rent the bubbles, but detach yourself so you don't become part of it, which is that's the sounds easy, but that's the very difficult part.
What the good analogy that in real world is like, you ever go to almost in every city in the world, there's an area where all the shoe stores are located or all the jewelry stores. Like you would think, oh, why would they all want to be together? They competing against each other. Like that's a bubble. If I put a jewelry store in a different neighborhood, I'll be unique. And it's actually the exact opposite. People are crowd animals. We are very much social animals, and actually, the more of the same thing there is, the more valuable it is. That's why, like, all the shoe stores are together and the jewelry stores are together.
Yeah.
You know?
And since what you spoke about before about the Pareto principle, not only is the most money made in those environments, but it's made by the fewest people because it like what sounds simple is really hard to put into practice. So most people kind of come to the market, like are introduced to the market during a bubble because of their friends are making money or it sounds good to get into it. But it really takes a long time to understand how to build like a robust process to make money over time. Like I always tell people, like it's an amazing business. Like I personally like love what I do. It's like my passion. It's not even my job.
Right.
But it's like starting a company. Like you don't think you'd be able to start a company and be great at it if you just like hop in and 2 months later you have this successful shoe company, like you said in your example. So like a bubbles, like they sound easy, but it takes a lot of effort to build a system that you can apply over time to not get burned by it.
So, given that, what you've taught lots of people, what would be your, basic recommendation to a general average Joe guy who is interested in the markets? What would you suggest is the best course of action for them to follow?
I would put people into 2 camps. Like, either the one camp is if you say, like, "The market intrigues me, but I don't have that much time to put to it, but I'd like to invest something." I always tell people, "Yeah, just buy an ETF. It's the safest thing. It's naturally diversified." Like you said, naturally, the winners will get more cash flow. And it's the reality. Like, to say there's, like, an easy thing, like, these are these 5 steps to make money, like, that doesn't exist in the market.
Right.
And if someone said to me, like, Matt, I have a fair amount of capital. Like, I really want to learn how to do this. Then it'd be, find the mentors that read like 5 or 6 important books. Find the style that speaks to you because we're all different. Like, even though I make money my way, I've tested everything. But, day trading could appeal to you, although I think day trading is way harder than what most people will ever consider, especially nowadays. But, it could be swing trading. It can be value investing. There's so many ways. Find what works for you and
Right.
like really learn that one style over a market cycle. And then after you can really build a business that you can do for the rest of your life that can be fun and you can outperform the market.
Right. What if you if you were sort of, most traders, retail traders that kind of watch the show, I would say are, um, amateur traders, they have real lives, they have other professions, but they're really fascinated by the market. What would you say to those traders? What do you think is the right mix of engagement there?
You gotta look at it like you wanna build a process. It doesn't have to be complicated. It has to be very difficult, but you have to have a process where if this happens, I'm gonna do this, and if that happens, I'm gonna do this. So it's the only way you can figure out what works, and then when things don't work, how to fix it over time. Because that's the whole business, everything is just like you're just constantly figuring out, "Oh, that didn't work. Let me change this." And it's like this iterative process of making yourself better. So, like, I don't think there's any secret to a really good trader. I think a really good trader is just someone who's diligent, persistent, and like, has a natural enjoyment for what he's doing. So I think anyone can do it, but most people kind of just do the feel good stuff without, like you have to track your process, like, oh, that didn't work. Why not? And like you have to put effort into it.
Right.
But I think most people I know trade while they work and it's a side business that they run for themselves and anyone can do it. But you need to have structure. You need structure.
Now, for people who want to find out more about what you do, and also maybe you can tell us a little bit about what you do these days, where would they find you? And where do are you on social media? Is there places they could reach you? And also tell us a little bit about what is it that you like to do these days as far as reaching out to the public?
Yeah, so I'm on YouTube. You can check out Caruso Insights. I'm also on
Is it your YouTube channel is Caruso Insights? Is that
that's right, Caruso Insights. The YouTube, there's
we'll,
the
we'll put
website.
also those links into the into the video, guys. But just to let you guys know. Sorry. So, and what else? And
Yeah, so there's that on Twitter. My handle's M Caruso, no, trader underscore M Caruso, or there's also the handle Caruso Insights for
okay.
like the company side of things, and also my website. And for me, like what I really try and do different with clients is, yeah, we look at like entries and exits, but like I try and teach it from like a portfolio process. Like, how does all this come together? Like that, like you're saying that secret sauce. To me, like when I said, am I going to teach people or whatnot? Like there's so many great books on candlesticks and technical analysis. It was really about how do I relay all the stuff I wish I knew when I started. So I talk about how do I build into positions, what am I looking at? How do I react in real time? And so that's what I kind of go through with members at my service and clients. And it's really kind of it's been a really interesting process because I've learned more about my process teaching other people because people will hold you to account at a certain point, like, hey, wait a second, that's not showing relative strength. Like you just kind of you like the story, and it's like, maybe even overstepping there. So it's been a great place where you learn the whole process and a community that's really dedicated to kind of figuring out who are the companies that are going to win the next 3 to 6 months or a year. So that's what I've been focused on.
And so, and do you spend like, is there, in terms of talking to your clients, you look at certain trade ideas and you say, this is what I'm looking at as kind of, you sort of look at trade stories, trade ideas, and talk to them about the entry process, the structure process of how you would position yourself into each one of those trades?
Yeah, so I have like a Google sheet where we track like every execution, every setup, and so it's like a mock portfolio that we build and run. And, it's great. We have video calls twice a week, and it's really so I always start off with kind of like the market view, what are the portfolio view, stock view, key themes, and there's a lot of, like, educational components and sections and all.
I'm curious what happens, because this always, of course, happens to everybody, but what happens when you go like 2, 3 weeks where it's just red, red, red?
People cancel their membership. It happens every single time. People come in wanting to learn, but then after when there's no action, they leave, but,
Yeah,
it's a natural part.
that's always the hard part, but that's actually the part you need to learn because that's the part that separates the winners from the losers.
For me, it's like, yeah, like if I do this represents what I do. And it's like, there's people are gonna come. It's not for them. They'll come and leave. But the people for me, it's a joy to be with people who want to learn and they want to
Mm.
stay. If you don't want, it's great. I hope you learn something and then you move on. But for me, like this has been a fun side business that I've was able to develop because social media kind of brought me some attention. So it was never like, I made my living trading since 2008. It's all I've ever done. So this is like a nice side business to run and enjoy and interact with others. So for those who want to stick around for the good and the bad, you're welcome. And those who just want to learn and then bump off when
Now
it's quiet, I get it.
now you're strictly sort of, meat and potatoes stock guy. You look at equities, you trade equities, so on and so forth. Since, you've started in the business, we've had enormous amount of growth in derivatives from everything from micro futures, mini futures to, of course, zero DTEs and we're now, I heard, I swear to God, I'm not kidding you. I heard the CBOE is thinking of doing hourlies. I mean,
Okay.
with the which is
Wow.
which is which is just insane. But the point is, I guess, there's just now plethora of derivative instruments. What's your view about all of that? And, have you, uh, you know, tested them? Have you tried it? Have you explored it?
So I'll trade options sometimes, but usually those that are like 3 months out. It's based around a position type of thing. But it's funny. I was talking with, we were speaking before about Jason Shapiro, who's a great trader and market wizard and all the rest. And he was telling me it sounded familiar. He's like, brokerage firms sometimes they want to hire me to teach traders. And then after they don't want to hire, they don't know, they have second thoughts sometimes because I teach them the real way, which is not necessarily what's best for the brokerage firm or the exchange, which is high order flow and high turnover. It's about being right, not the number of trades you put on. So I think a lot of that, unfortunately, is like got a flavor of gambling to it, and all of the rest. I mean, there's money to make in every single possible way, and I think the markets, if you treat them like a gambling house, they'll be a gambling house. If you treat it like a structured business, it's a structured business. It's how you want to treat it. So I think for those who want to do it, there's opportunity. Like just speaking of like career and stuff, like eventually I got tired of being glued to the screen at all times, and where I have 100 open orders and I can't leave my desk anymore. So for me, like it's a natural part of like life cycle is I like to know that I can step away and I don't have to worry about 100 orders going off and all the rest. So for me, it just doesn't interest me as in terms of the time commitment that it would take. Like for me, it's more exciting to look at the stories, understand them, and build out than just be pure price, reaction like I
Right.
did for swing.
Just where do you sort of where does all that information come from? Do you have a Twitter feed that you follow? Do you read certain publications? Do you watch certain TV shows? Like, where is the initial knowledge come from?
So I like to always screen for the companies that are working. And one of the best places I like to go to is just the investor relations sites because the better companies will just tell you what the story is. Like a lot of it is going to be fluff and maybe they're exaggerating. Like
But you said you like to screen for companies that are working. How do you have a screen of like, what is the initial screen of like, what would be like the first thing you'd want to see? Is it volume? Is it price performance? Is it what
for me, it's always relative strength. I'll look at the best, the top, like the top decile of the past 3 months, past 12.
top deciles 3 months? I want to learn about all these guys. And then I'm
And
gonna go.
to me, it's not just the price action; it's the relative performance. Because if the market's up, you got to outperform that market, or if the market down, just being flat, you're doing amazing. It's always that relative view is how I
Yeah.
remember it.
Yeah. It's always a relative game everywhere.
Yeah.
It is you learn that in finance all the time. That's really interesting. So it's relative performance first. That's your starting base, and then you just
Mhm.
go out there. You may even go directly to the source. You go to the company's websites.
And once you get the sense of the company, like, and again, this would happen sometimes in the past where it's like I'd see a company, it's making 52-week highs, got great relative strength, and I'd be like, ah, that's an old company. What could they possibly be doing? And then you find out because you were sloppy, you didn't look into what the new story is. Like, oh, but they had changed that element of their business, or there's this new theme that you didn't realize they were. They may sometimes they just luckily fall into a new theme, like all these utility companies.
Right.
There's nothing sexy about a
No,
nuclear
no.
power
They were
plant.
just they were just at the right place at the right
They're
time.
totally the right place at the right time. But if you didn't get it and you said, "Oh, it's nuclear power plants," you missed the theme. But
I
if you
was,
go
I
to
was,
their
it's
site,
funny. I was going to talk to you about
yeah.
that. I think nuclear is going to become just probably the next big sector. As long as once we start clearing the regulatory barrier, because there is no solution like that is a reasonable solution for the enormous amount of energy we're going to need aside from nuclear. Yeah.
Well, and if you go to these sites, like they want you to buy their stocks. They're gonna like I said, you can't trust everything the company's saying. That's like going on Twitter and trusting what every bull will say about like a stock that's up on the day. But once so let's say there's I don't know, there's 6,000 stocks. When you screen by relative strength and you put some normal price parameters, maybe you're down to 3 or 400. Of the 3 or 400, like you find the ones that are like the ones that you prefer, or maybe for you have already fundamental growth, you get down to 100. So once you get to this list, the first time takes you quite a bit of time. Each week, maybe you're taking 5 off, you're adding 10, then you're taking off like 6 and you're adding 2. And as you're adding each week over time, you're going to their investor relations site. You're looking through their presentation deck and like, oh, this is, Celestica. They make components for data centers. And like, oh wait, VR2, they make cooling for data centers. Oh wait. And then so it starts, oh man, big rush for like all of these like data center, like empowering components or
So it's like Rafa Caparsa. You're actually building the theme from bottom up because you're
100%.
interesting.
Like recently, if you have you noticed all the hardware, it's not the hard drive manufacturers have been like
Yeah, like what is up with that? Like, 'cause I'm just a straight up NQ trader, but like, Seagate, like what is the story there?
so this summer there was about 2 weeks where the Nasdaq had a hard drop Seagate did not budge. Like it went just silent. It's as if it was in its own world. So I said, okay, let's see what's going on. So I go in, and nowadays, because like the theme is AI, it's like, scan for AI. And it's got to make sense though. Like I don't want to be like, oh, AI and the stocks are going.
Right.
But they said, their new products are new hard drives that are specifically built for rack size for AI data centers, which they didn't have before, and they're just launching now. So I said, okay, then you go to SanDisk, similar story. We're scaling, and they were held private. They came to market because they want to take advantage of the new public market. So it's like, okay, here's this theme where suddenly, and it makes sense. The more everyone uses ChatGPT, there's a heck of a lot more data we're gonna have
Oh
to
yeah, like
store,
I alone probably generate a gigabyte of data. Yeah.
right? And what's different about the chatbots is like it learns about you. So like it knows what you ask. It's not like Google where each search is like sent and gone. Like here, it's like a bill. So you need tremendous amount of data storage. So I look at this story. I look at how SanDisk, Seagate, Western Digital, none of them even budge as the Nasdaq falls 5%. The second the market went tick, these things all exploded out of the gate. And so it's like you'll see these things only from bottom up because they're all. If you just search for like I don't know industry groups or sectors, like title is so big, you'll never find anything. And so it's this process. And like if I wouldn't have gone to the site, I wouldn't have seen like, oh, they have these new things specifically for data centers. And
Right.
look at Celestica, they're made for data centers. They've been flying, and so is Astera Labs. And that's how I kind of build my views.
Fascinating. It's really interesting. Well, Matt, we can talk forever about this. This is so
Absolutely.
fascinating. I want to just end with just one last question, which is, what do you think is sort of the biggest lesson the dot-com era investors could teach to the AI boom? Like, if I've gone through the dot-com boom, and
Mm.
I still say there was never as crazier time in market as it was then, because it was just really, really crazy. Um, Even the AI boom just pales in comparison in terms of the amount of speculation that happened. But what are the lessons you think that we can all take away from that?
One thing I've experienced myself is if you're fortunate enough to be in that bubble as it's happening, and hopefully everyone does at some point, take money out of the market. Like you have a good run, like take it out. Like I was a trader I once knew. He said, he's like, take the money out, give it to your wife. Don't worry, you'll never see it again. You'll never touch it. I, so whatever you do, like if you have a mortgage, pay off your mortgage if you're lucky enough, or pay, like just make sure that that you're in something that is not normal, that's not going to continue. You're in the right place at the right time. At least if things do go wrong, you say, wow, at least I set myself up where I can try again, and I materially improve my life. Like the worst thing that you're always going to kick yourself is if you made all this money and then you just gave it all back and then some. So like fix yourself up so that, no matter what, you'll be doing well.
Yeah, exactly. I think it's worse to make and give back than it is to just try and lose a little bit. I think it's
There's so many good opportunities every year, 2 years, 3 years. If you
right.
made an incredible amount of money, take it. Worst case, you could have made a little bit more, but if you actually know what you're doing, you'll make it again elsewhere. And if you don't know where you're doing and you got lucky, at least you'll save yourself a lot of heartache. That's the
Right.
way I look at it. So,
Yeah, 100%, 100%. Well, thank you so much. Let's let everybody know again, website or any the most immediate place that it's Trader Matt
trader underscore M Caruso, but you just go to carusoinsights.com.
Russo Insights.
Everything is available there.
Very good, very good. Well, thank you again, Matt. Thank you so much for being with us, and everybody else. Thank you again for being with the Trading Battle. We will be back to you with some of the great interviews coming up the next couple of weeks. Be sure to, of course, hit the like button and subscribe to let you be on the list of what's coming up next. I hope you guys really, really enjoyed it. I certainly did. With Matt Caruso, tradinginsights.com. Over and out.